Welcome to Keiretsu Forum Presents. My name is Randy Williams, proud member of Keiretsu Forum, also the founder and CEO. We have grown from one chapter 17 years ago to 49 locations globally. We are in the world of startup or angel investing. This show is designed to be content rich and give you ideas about the risk and the opportunity of angel investing. We're having a lot of fun the last 17 years. We're going to be talking about a lot of things in this show, from liquidity events to fundings, etc. Today we have Craig Martin, CEO of Family Wealth Consulting Group. His topic is risk managed portfolio using alternative investments. So what does that mean?
What does risk managed portfolios mean?
Yeah.
It means the total portfolio has less volatility, has a managed volatility that's comfortable for the client, so that the client can go to sleep at night. It's called peace of mind. Mm-hmm. Building peace of mind.
Okay, well that's still complicated for me. So let's just dumb it down. So
okay.
You have in your world the opportunity to obviously invest your capital and your client's capital in the stock market. You've chosen to do, yes, a little bit of that, but more on the alternative side, which is real estate, which is angel investing. Continue.
Yes, as well as alternative income. So that's why I'm been a proud member of Keiretsu Forum for the last 12 years, Randy, because it brings deal flow to me and mind sharing, helping me pick the best investments possible. Mm-hmm. And my clients and I co-invest in both real estate and angel investing in business startups, as well as alternative income.
Okay. Not to put all private wealth advisors in a bucket, but primarily they're most comfortable in the public world, i.e. the stock market. You are comfortable in both worlds, the private side, which you just alluded to, many instruments, from investing in homes, investing in multifamily, investing in angel investing.
Yes.
What historically does your clients and you want in the alternative space?
So the purpose of alternatives is to manage the risk of the portfolio. So yes, we have a core risk managed portfolio of stocks, publicly traded stocks, and the volatility of that is measurable. It's called 18% standard deviation. But if I add alternatives to that, I can reduce that volatility down to something significantly less. Mm-hmm. And as I reduce that volatility using alternative investments, I also can increase the expected returns. So most of the alternative investments in both real estate and angel investing in business startups have a higher historical return than what we could expect out of a risk-managed, publicly traded stock portfolio.
So you, before the show started, were talking about some of your influencers, i.e. you said there's 3 Nobel laureates that have shared data and information to you and your organization. Tell us who they are and how they've influenced.
Oh, great. I could talk forever. How many hours do we have?
You have, to answer that question, you have 2 minutes now.
2 minutes.
2 to 5 minutes.
Okay. So, yes, I've studied under 2 Nobel laureates and read the third one. 2 Nobel laureates. Harry Markowitz won the Nobel Prize in 1990 taught us how to build a risk-managed portfolio. Mm-hmm. And then Gene Fama won the Nobel Prize in 2014. And he taught us about efficient markets and the 3-factor model, where the returns are in the publicly traded stock market. Daniel Kahneman won a Nobel Prize in 2004 for what we now call, he's a psychologist, and what he revealed was why we think the way we do about money. Not what we think so much, but why we think about it. Truly a revealing study. Mm-hmm. His book is called Thinking, Fast and Slow, and he changed my thinking, mm-hmm. the way I build my life, and since his work, most articles about investing include a discussion of behavioral finance, because what he taught us was so apparent that it represents who we are as human beings. Mm-hmm. A popular quote from Daniel Kahneman is that we're born with a brain, a human brain, which is great. It's gotten us where we are today after however many centuries we've been here. However, it's not programmed to work in the financial decision making easily. And most people make exceptionally poor investment decisions, not because they're dumb or uninformed, but simply because that's how their brain works. And his work helped us understand why that exists and how it exists. Very
well,
revealing.
ironically, 17, 18 years ago, or going back past maybe 20 years ago, when I was dreaming up starting Keiretsu Forum, I looked at my weaknesses. I looked at the fact that I love startups. I love the whole ecosystem. I love working with the jockeys.
So do I.
Or the CEOs. And but I was pulling the trigger too quickly because of my enthusiasm.
It's easy to fall in love with all of them.
Exactly. And so I wanted to create a model where no one had a vested interest, including myself, where we are all helping each other be smarter, more efficient investors. But when you invest, the money goes directly to the entrepreneur. It doesn't flow back to the organization. But the premise then and is now is how do we help each other? And I've made 53 investments at Keiretsu. And if I didn't have Keiretsu in the private equity world we're in, I'd probably lost my money because now I have mind share, I have discipline, and I have smarter people than me to help me be a better investor.
And particularly in a particular industry, so real estate and or high tech and or medical science and or medical products, all of those we have experts in the Keiretsu group for all of those different areas. Yes, I've been able to expand my portfolio significantly because of that swarm intelligence, being able to attract those people into our due diligence teams. So you're ahead of me, Randy, on the number of investments, but angel investments, we've done 27 of them, and
Through
for
Keiretsu,
real estate,
at Keiretsu, yes,
and the real estate projects, there was a point where we had 70 plus addresses that my clients owned. With now we've got 14 different real estate general partners in the project.
But let's go back to Nobel laureate for a moment and about the mind. That's fascinating. So the book is
Thinking Fast and Slow.
Okay, and I've heard a lot about it. I have not read it. And so why do you recommend it? Is because humans, we have a tendency not to process things. A lot of us don't process things correctly in regards to how we make a financial decision.
Our brain works very fast, and survival sometimes depended on us being very fast thinking. And there is a part of the brain which produces fear for us, amygdala, and the combination of fast thinking coming from fear causes us to make very poor investment decisions in general. Okay, with a lot of training, I am now aware of many of my previous ways of thinking and why I had so much trouble. It doesn't mean that I've overcome all of my cognitive shortcuts, but I'm certainly much more trained, much more experienced. I'm able to observe it in other people easily now. And I consider behavioral finance a directive for me in my investment choices and helping clients overcome their cognitive shortcuts about investing.
Wonderful.
The world talks about a risk tolerance as if there is a number or description, and all the evidence says that risk tolerance is a matter of the moment in each brain. That today we're real comfortable and peaceful and have a different description of how we want to build investments and what we want to produce out of them than tomorrow when it is entirely different. And that can be affected by individual health or circumstances or events or global events.
Well, again, we're taping right now in January 2017. We have a very, I think, a special liquidity event coming at us at Keiretsu Forum. I believe you are a shareholder of this company, as I am.
Yes.
And this company is in the quiet period, so they can't tell us everything. But the company is solving, and you're about to talk about impact investing. We like social bottom line investing. We want to make an impact. We want to do good in the market and the world. and
Very
also
much so.
make a return.
Oh, yeah.
This company's hopefully solving MRSA issues for cystic fibrosis, young kids throughout the world.
We're saving lots of lives.
And so we invested in this company, and the valuation was under $20 million. Correct me if I'm wrong. They are doing a reverse merger into a shell company with a valuation over $120 million. How we got there was Swarm Intelligence. Do you recall when the CEO, he's been on my show before, Rob Neville.
Rob Neville, good.
Yeah, and he's in my, so how did we make that decision? What stood out about him, the jockey? What stood out about the opportunity where we, fast forwarding years later, are going to have off our capital, if you invested early, like you and I did, we're going to have maybe a 4, maybe as high as 6, but who knows? Let's just dumb it down and say a 4x on our money. So we invested $1 million, you're going to get $4 million. Right?
Yes.
So, remember the mind share, as you called it a moment ago. What was the mind share in Swarm Intelligence? What resonated with you as you have a fiduciary, obviously, not only for your clients, well, not for yourself because you invest individually too, but for your clients. How did you make a decision to invest in Sephora?
Yeah, so good point. As a registered investment advisor firm in the industry, I do have a fiduciary responsibility to my clients, which means full disclosure. Their interests always come first, and I am regulated under those rulings. The opportunity to work with Keiretsu members meant that when Rob Neville presented to us his business opportunity in Savara, interested angels got together and formed what we call a due diligence committee. Mm-hmm. And I was part of that original due diligence committee. Mm-hmm. The effort was to make sure that Rob's story was as he presented it, and that his business model had potential, and that his IPO was real, and that his numbers and projections were possible. And if we, at the end of that due diligence process, we think, as members, we thought that was what we wanted to, that we liked what we saw, then we would write a check. And what I did was take that due diligence report back to my clients, mm-hmm. and we sat down and talked about it together. And I reported what we had written up in the due diligence report. And my clients had a chance to say yes or no on that. And so we made an investment. Several times I've heard that we invested at closer to $20 million. My notes show that we came in at closer to $13 million. Current valuation on the company going into the reverse merger is $115 million. And the public company that they're merging with has a capitalization of $35 million. So if you add the two together, it's $150 million. Mm-hmm. So my original investment, closer to $12 million, has about a 13x return, the way I'm calculating it in that description. Mm-hmm. We'll find out. Right. When this thing happens.
But it's fascinating, too.
In all cases, it's much more than what the public stock market could ever produce reasonably.
Yeah. And it's OTC, so it's going to be thinly traded, I would imagine.
Yes.
But you mentioned a couple things. So we are collectively doing due diligence, and then Keiretsu Forum is a facilitator. So when one makes investment, you or any of your clients, 100% of the dollars goes to the entrepreneur. We're all here to help each other. And you brought it back to your clients, and you said, interesting, and so you decided to pull the trigger, and you did. Congratulations.
Yes, we've made several investments in that company, as we do in most of the angel startups.
Right.
Angel investments in business startups, right. Because things happen, the world turns, and they need more money usually.
Well, interesting point, because personally, I like milestone investing, meaning when a company's meeting its milestones. And most companies, startups, always need capital.
Yes.
And usually that's fueling, obviously, sales and marketing, or fueling a place that they get to break even, take the risk out of. For us, it's angel investing. But I like milestone investing. And sometimes, you can get hurt by that. And you can't fall in love with the jockey or the CEO too much, or the company. But you have to see if it's milestones, if they're meeting it, and they're moving up hockey stick, and they're and sales and marketing, and also numbers are improving, and then why not come in a little bit, and then possibly give them more down the road, which you do.
Yes. So we're apt to put a small amount of money into the original investment, and as they achieve milestones using our money on time, under budget, hopefully, then the second round is readily available. They've proven themselves.
So I've known you now close to 15 years, Craig, and I saw you on a panel this weekend in Phoenix. We were down there, a lot of us doing due diligence on this real estate company, but on that panel was all private wealth or RIAs.
Yes, registered investment advisors. There was 4 of us on that panel.
And they were all very credible, but you were excellent because you really are drilling down on something near and dear to my heart, which is alternatives.
Yes.
And so if I came to you, and there's no info commercial in this program, but you obviously talk to your client and you ask about their risk tolerance, and then you design a portfolio. Okay, that's pretty standard practice, but you suggest having him think. I mean, you obviously, your office is here in Silicon Valley, so you are obviously gravitating toward the ecosystem of startups.
Yes, yeah. As we've said, Randy, working with founders of companies, young CEOs that are starting companies is very exciting. Being part of that decision-making process, watching them grow, the potential of that exit is very exciting. Yes, I'm using alternatives as a risk management tool, having studied under the Nobel laureate. What Harry Markowitz taught us was that if we mix dissimilar price movement asset classes, so if you've got large cap stocks in your portfolio, something besides that has a dissimilar price movement. So real estate has a different price movement. Business startups have a different price movement. Alternative income has a different price movement. So when the stocks go whiz, your alternative investments are going bang. Something different, okay? And the more diversified the portfolio into alternatives, the lower the volatility of the total portfolio. And because alternative investments have a higher historical rate of return, then we can hope for those higher returns in our portfolio, which will increase the return of the total portfolio. So a way to describe that is that our real estate, we distributed over $600,000 of profit last year. The earnings rate in our fund to earn that money was 25% per year, internal rate of return. We can't get that in the public stock market, 25% return per year. Many of the existing, all but one of the existing real estate managers inside my fund have a long track record of earning close to or in excess of 20% return per year. The likelihood of us earning those kinds of returns from those general partners going forward is very high. And because we've diversified so much, over time and between managers, we've got a hugely diversified, effectively diversified portfolio, and our clients are getting 15 to 20% liquidity every year. Projects that are over 5 years old are now starting to liquidate, so we get 15 to 20% liquidity each year. The angel investments, public records, Professor Wiltbank at Willamette University has done research on this with the Kauffman Foundation and shows an average rate of return per year of 27%. So a hugely diversified portfolio of angel investments, I mentioned earlier that we've got a couple dozen or more, shows a higher rate of return than what we could expect out of a publicly traded stock market. But added together, they form a portfolio that has less risks than just one of those, the stocks or the real estate or the angel investments.
Now we've designed at Keiretsu Forum a family of funds that top off our best deal flow. So we have venture funds topping off our best deal flow. Now we have a real estate fund. We feel to get those returns you're just alluding to in the real estate sector that we have to go to secondary or tertiary markets, meaning we have to leave Northern California because the cap rate compression, the price obviously is so high right now to bring into and we are investing in sponsors. We are a fund to fund in our real estate fund with low fees, but we are investing in sponsors around the country. So my question to you, your returns, are they mostly out of area too?
Oh yeah. So what we've got 14 real estate general partners. 20 years ago, almost 20 years ago, when I got started with the first real estate general partner, they were buying properties in Hollywood. Over time, they began to buy properties, stopped buying properties in Hollywood and started buying them in Northern California, and then ended up in Santa Barbara and then back to Northern California. So that's one general partner that deals with just the West Coast state called California. Everybody else is outside California. And we're getting returns in other states where general partners are also floating around between geographic territories over time, and getting returns out there, lots of them in the 20% per year range. Yes. So you need to go where what we've discussed. The way I perform due diligence on those companies is that I want to make sure that they're in an area with strong demographics, strong employment, diversification of industry, average prices are, cap rates are conducive to growth. So there's lots of indications how real estate purchased today can produce better returns into the future, and the best general partners are doing that consistently.
So job formation is critical. Obviously, schools are critical. Jobs, current jobs, obviously.
Yeah. So we were in Phoenix with this other real estate project this last weekend, and they have several universities there which have really raised the potential for real estate in the area because they provide lots of education, lots of jobs. They attract high-quality jobs to the area. And employers are moving into the area because they've got high-quality employees to hire, educated employees. That's a good indication.
Okay,
of
so that's
the
real estate.
demographics.
So getting back alternatives, investing in startups.
Yeah.
So let's have some fun here. This is not scripted. So let's try to get 10 out. Let's talk about the 10 most compelling action items for you and I before we pull the trigger and invest personally, or maybe you invest for your clients. But I'm going to be talking about myself. So I'll start number one. I would say the jockey is critically important, the CEO. That's number one. Now let me back that up. For getting back to Safara for a moment, we talked about. He had quote unquote over a 30x. He quote unquote for his past company, and then he brought Safara to us, and he stood up in the forum. I said, "Well, how many of those clients are in this one?" He said, "Well, all of them, of course." Yeah, I like that answer.
Yeah.
And so he was seasoned. He had obviously experience in the life science orbit, and he had great moral ethics, great moral compass, and I like the jockey. Okay, that's number one.
Yeah.
Give me number two.
Yeah, let's talk about the industry. In this case, he's powderizing an antibiotic for treating cystic fibrosis patients with medically resistant Staph aureus infection, which has become a killer in the past 5 years.
Okay, now let's get back to the subject. Okay, jockey's number one. Give me number two, why you invest. The top 10 reasons why you pull the trigger and make an investment.
After jockey,
yes, after jockey
is the industry. In this particular case, it was very appealing to work. It's a high-impact investment. It feels really good to be able to save lives. If we can make this work, if we can put enough money into this company for that he can execute his business plan, that's a real feel-good.
Okay.
That's an impact investment.
We got 5 minutes left in this program. Here we go. Number three, I would say strategic. What I mean there is most of our exits are not IPO. We've had IPOs in our portfolio at Keiretsu Forum, but strategic investments are very, very important for our portfolio. So I want that CEO to know the CMO and the CTO and the CEO, the C-level, whoever's going to buy them. If Google's going to buy them, do they really know? So I would say that particular jockey better know strategic's going to take them out for exit. Is that clear?
Yes.
Okay. So we'll call that strategic. That was strategic buyer. Okay, number four.
Business plan. Has he written a business plan that he can execute? In this case, he's got experience. He wrote a business plan that fit this business model to a T. And during due diligence, we spent an extensive amount of time talking to people who knew him before and are working with him now, and proved to us that he could that the business plan he had written he could execute and get the exit that we'd hope for.
Okay. So I will say execution along that. I want to see, and every business plan changes, I want to see if they're executing, but I want to see if they pivot. And it's fascinating to me when I stand up the forum and MC a meeting and I say, here's a resource. And I say, here, I will give you a resource at, name a company, AT&T, or I'll give you a resource at Google. You just have to ask. And if they don't call me, I don't want to invest in that company because they have to mine our resources and capital, but it's fascinating. So execution is very important to me. So execution on raising or being persistent and getting my money.
Yes.
And if they can't get my money, they're not going to get a customer. So execution. Okay, that's 5.
Advisory board.
Okay.
So advisory board is the people that give the CEO the direction, the knowledge, the industry experience. They bring the connections into the CEO, and becomes the critical, can be a critical part of that business's future.
Great. Okay, I'll go number 7 would be moral compass. I care deeply about their efficacy, I care about their reputation, and I care about them doing the right thing. That gets back to impact or social bottom line investing. My wife and I prefer that type of investing, but I want to make sure I'm dealing with an honest jockey. Number
8, patents and or trademarks and or secret sauce that nobody else knows. A patent can protect us as we enter into the market with a new company. Trademarks and secret sauces really make the difference.
Okay. Number 9 would be the ability to receive knowledge from other people. Yes, I want strength, I want execution, but I want them to really be listening to their investors.
Coachable.
Coachable. Okay, you have 10?
I answered your question. So 10. Let's look at the what am I missing? Oh, the finances.
Yeah.
So before the risk of angel investing in business startups is huge on each individual investment. The only way you can protect yourself is to diversify into dozens or more of deals. So I want a projected exit that gives me a projected 100% IRR, and that's one of the things that we looked at in due diligence.
Okay, I'll go 11
we did
now.
10.
I know 10. 11 is
you're going to beat me.
I want to have fun. I want to have fun in life, you know. And we go through this life very quickly.
Big.
Let's have fun with our CEOs, have them listen to us, and let us help them, obviously, on the path towards success.
That's truly a fun part of the business.
So thank you so much for listening. Keiretsu Forum Presents. If you want to hear other shows, please go on to YouTube. We have about 12 in the bucket. Come back next month. Thank you so much.